charts are a bloodbath. Panic is in the air. Bitcoin has plummeted to levels we haven't seen since June, wiping out over $760 billion from the total crypto market cap in just a month. If you're feeling that fear right now, you're not alone. But what if I told you that this entire sell-off is hiding a massive secret? That while retail investors are in what experts are calling max desperation, a silent, powerful force is quietly positioning itself for the next massive rally. In this video, we're breaking down the real reason for this crash and the one institutional trend that suggests this could be the biggest buying opportunity we've seen all year. If you're looking for someone to tell you whether to panic or not, you've come to the wrong place. We're here for the facts, the data, and the deep insights that help you make smarter decisions. Today, we're diving into a tale of two markets. On one side, we have the frantic retail sell-off. On the other, we have a stunning report from CME Group showing record-breaking institutional activity. Understanding this divide is the key to navigating this volatility. Let's break it down. Decoding the drop, why prices are really falling. Let's start with the obvious question: why is the market down? Bitcoin has broken below $104,000, and the pain has spread across the entire board, with major altcoins like Ethereum, Solana, and Dogecoin all seeing devastating double-digit losses. The immediate trigger isn't a crypto-specific problem. It's a broader market phenomenon. We're seeing a pullback in risk-on assets, from tech stocks to crypto. AI giants like Nvidia and Palantir have tumbled, taking the major stock indexes down with them. This has created a risk-off mood, and when that happens, investors flee volatile assets like cryptocurrency first. But here's the critical layer that explains the intensity of the crash: the retail leverage wipeout. Bitwise Chief Investment Officer Matt Hougan perfectly described the current retail sentiment as being in max desperation. What does that mean? It means that over-leveraged traders who bet on prices always going up have been liquidated in a massive cascade. We're talking about over $2 billion in long positions getting wiped out in 24 hours. This forced selling creates more selling, and it's a brutal emotional cycle that amplifies the downturn. Why this matters? This crash is less about a failure of crypto's fundamentals and more about a short-term, macro-driven panic attack combined with a brutal flushing out of weak leverage. It's a painful but necessary market cleanse. The institutional secret: record growth in the shadows. Now, this is where the story gets fascinating. While retail is panicking, the institutional world is sending a completely different signal. Let me hit you with some data that might shock you. According to a recent CME Group quarterly report, the third quarter of 2025 was a period of record-breaking growth for institutional crypto products. We're not talking about small numbers here. The combined crypto futures and options volume on CME, the world's leading regulated derivatives exchange, exceeded a staggering $900 billion. Average daily open interest, which represents the total number of active contracts, reached a record $31.3 billion. This isn't just quick trading. This is big money establishing long-term positions. Perhaps the most telling stat: the week of September 16th saw a record 1,014 large open interest holders in crypto derivatives. That's over 1,000 major institutions, hedge funds, asset managers, corporations, actively building exposure in a regulated environment. This isn't just a Bitcoin story anymore. The institutional appetite is diversifying at an incredible pace. Ethereum futures set a daily volume record of 543,900 contracts on August 22nd. Solana, SOL, and XRP futures reached all-time highs, with SOL futures open interest soaring past $2.1 billion. The report notes that Solana futures were the fastest contract ever to double its open interest past the $1 billion mark. This is a clear signal of growing institutional confidence in altcoins. Why this matters? This data is a powerful counter-narrative to the retail panic. The smart money isn't running for the exits. They're using this period of lower prices and volatility to build massive regulated positions through trusted venues like CME. They are playing a long-term game, and their actions speak louder than any fearful headline. Beyond the crash, the megatrends shaping 2025. Okay, so institutions are buying, but what are they betting on? They're not just betting on price, they're betting on the foundational trends that are set to redefine the entire crypto landscape this year. Let's look at the three biggest ones. First, the unstoppable rise of real-world asset RWA tokenization. This is where traditional finance and crypto collide. Imagine being able to own a fraction of a skyscraper, a masterpiece painting, or a government bond. Tokenization makes this possible by turning physical assets into digital tokens on a blockchain. And the big players are all in. BlackRock, the world's largest asset manager, has already partnered with Securitize to launch its first tokenized fund on the Ethereum network. This isn't a niche experiment anymore. It's the beginning of a multi-trillion-dollar shift that brings immense liquidity and institutional capital into the crypto space. Second, the tectonic shift in stablecoin adoption. Stablecoins are no longer just an on-ramp for crypto trading. They are becoming a core part of the global financial infrastructure. Visa reports that stablecoins are now used in 1 billion transactions each year, transferring a total value of over $8 trillion. And the next wave is even bigger. As one analyst from a 16Z crypto points out, we should expect a wave of enterprises, from coffee shops to large corporations, to start accepting stablecoins for payments to save on the massive fees charged by traditional credit card companies. This would add billions directly to their bottom lines. Third, the merging of AI and crypto. Two of the most transformative technologies are joining forces. We're seeing projects like Render, which creates a decentralized network for GPU rendering power, crucial for AI development. Even more significant is the proposed merger of AI giants Singularity NET, Fetch.ai, and Ocean Protocol into the Artificial Superintelligence ASI Alliance. This aims to decentralize the control of AI, preventing it from being dominated by a few tech giants. The potential here is limitless. Why this matters: institutions are investing with these long-term, fundamental shifts in mind. The price action we see today is just short-term noise against these powerful, structural trends that are pulling traditional finance and technology onto the blockchain. What this means for you navigating the chaos. So with retail in max desperation and institutions in record-breaking accumulation, what should you, as a crypto investor, be doing right now? First, understand the sentiment cycle. Periods of max desperation often coincide with market bottoms. As Bitwise's Matt Huggins stated, "I think the sellers are nearing exhaustion and the buyers are still relatively hungry. I think we could end the year close to or at new all-time highs." This fear is a normal part of the process. Second, zoom out. Look beyond the red on your screen and focus on the adoption curve. The institutional building blocks, regulated futures, tokenized real-world assets, and efficient stablecoin payment rails are being put in place right now. This is what will fuel the next leg of the bull market. Third, manage your risk. This volatility is a stark reminder to never invest more than you can afford to lose and to avoid excessive leverage. The traders who got liquidated are a lesson for all of us. So there you have it. A market caught between short-term retail panic and long-term institutional conviction. The weak hands are being shaken out, while the strong, smart money is steadily building its position. This is the moment that separates the impatient speculators from the patient investors. The fundamental story for crypto has never been stronger. Now I want to hear from you. What's your take? Are you seeing this dip as a buying opportunity, or are you waiting for more stability? Which of these mega trends, RWA tokenization, stablecoins, or AI, are you most bullish on? Drop a comment below and let's get a discussion going. The best insights often come from this community. If this deep dive helped you see the bigger picture, then smash that like button. It really helps the channel. And if you want to stay ahead of the curve, subscribe and hit that notification bell. We break down the complex world of crypto into simple, actionable insights, and you don't want to miss what we cover next. And speaking of what's next, in our next video, we're diving into one of the most controversial topics in crypto right now: meme coins. With major asset managers like Grayscale now adding Shiba Inu to their watch list for a potential ETF, are these joke coins finally going mainstream? The answer might surprise you. Until then, stay smart, stay safe, and I'll see you in the next one.